It comes down to liquidity. Ultimately, everything comes down to liquidity. And so on the negative side, US money supply growth went negative, right? Hadn't been negative for almost 100 years, for 96 years. It's pretty incredible when you think about it, 96 years straight of increasing the money supply. But that leads economic activity by 16 months. So you're gonna have a downturn, and inflation is gonna moderate. And the shelter component of inflation is collapsing. So that's all gonna moderate. And I don't think it's gonna go negative and deflationary, but it's gonna moderate. But the thing that is countervailing, and the cross-border capital guys, I don't know if anybody knows them, but they are amazing.
Oh yeah.
I mean, just amazing. Yeah. And they have the chart, and I've been tweeting it out a lot lately. It's $1 trillion with a T, trillion since October.
Hey guys, welcome back to Library of Wealth. Today we have Morgan Creek Capital's Mark Yusko giving us a market update and why we can't trust the numbers coming from the Fed or the media. Yusko points out that the Dow Jones and the Nasdaq have been relatively flat this year. He's slightly concerned about this and notes that the negative GDP we've seen over the last year by definition showed we were in a recession. He also mentions that corporate bankruptcies surged to new highs in the fourth quarter of 2022, which contradicts the numbers we're seeing now. Let's get right into the interview with Mark Yusko as he discusses what we can expect in the market in 2023. Don't forget to hit the like button and subscribe to the channel if you enjoy the content we do here. Let's get right into the video.
If you asked people, how's the market, the equity markets over the last month? Everybody's, they're up a lot. They're not. They were up a lot the first couple weeks, and now they're kind of downish to flattish. The Dow is actually flat for the year. Nasdaq's still up a decent amount, but it's basically flat for the last month. And I think there's a pretty big yin and yang going on between realities of economic data and narratives of no landing. Ultimately, this idea of no landing to me is kind of silly, right? Because no landing implies that we're still at 30,000 feet cruising along in the air. That's clearly not the case. This is not a perfect economy. We had a year-over-year change in GDP last year of 0.9. That is stall speed, right? That is below the natural rate of growth, which is around 2%. So that is definitionally a recession. Now, they're not going to call it a recession because of the fake jobs numbers. Here's a crazy thing. The 1.5 million jobs, quote unquote, that were created in the last year. All those are this BLS nonsense of the birth-death ratio.
Right.
But here's the crazy thing. Rosie pointed out, and I just saw it again, corporate bankruptcies surged to new highs, particularly in the fourth quarter. And so if companies are going bankrupt, how can there be net positive birth-death, right? Just definitionally. And so they're clearly just ignoring that and saying, hey, we're still in an expansion, therefore technically the birth-death ratio is X, and we're just going to ignore that corporate bankruptcy data. And the number of bankruptcies / layoffs, I don't know, those all seem to be up and to the right. And it has to do with financing of the financial system. So Japan in particular is one of the primary carry trade financing centers and has been for years because they had zero interest rates. So you could borrow at zero, you could take that cash and go buy other assets, whether it was US hedge funds doing it or European hedge funds doing it or whatever. And basically the Bank of Japan facilitated that whole thing by just being the buyer of last resort for the bonds. Because who would buy a bond that paid zero interest? Who would buy a 30-year bond paying zero interest? Well, no one. So the Bank of Japan waves it in, prints money, puts that money into the system, then foreigners come and borrow money from those Japanese banks, pay them basically no interest, but they don't need interest because they're being kept afloat by the Bank of Japan. And this is why Kyle Bass just wants to pull his hair out. And he has great hair, by the way, but he wants to pull his hair out because he's been saying, well, this is not sustainable. And there's these books written that once you get to 100% debt to GDP, it has to fail. Well, they're at 226. It hadn't failed. So that's part of it. So the Japanese carry trade and just the money actually ends up in meme holder accounts because Goldman borrows a bunch of money from a big Japanese bank and starts buying stuff. Well, then they offer, well, it's not Goldman, it's UBS and Merrill Lynch and Robinhood. And then they give all their users credit. So that's why margin debt in the United States went like this. So the two things I watch are margin debt. So if margin debt's expanding, then the meme stocks are going to rip. If margin debt's contracting, meme stocks are going to get crushed. And that's exactly what happened. Last year, margin debt collapsed because people had to make margin calls because stocks were going down, and it exacerbates. But starting in October, China floods the world with money, and that money finds its way into the big houses. Ken Griffin's house first, always. And the second one is these global liquidity, because, well, wait a minute, it looked like US liquidity was expanding, but then it contracted. Well, then how is global liquidity suddenly? Well, it's because, and you see this in currencies. It's because I believe there is a concerted collaboration, right? That these central bankers get together, and it's a process of saying, okay, Europe, ECB, you're going to have the strong currency, so the rest of us can devalue our currencies and be mercantilist and sell a lot of stuff globally. All right. So you're in the hot box for the next 9 months. Then we'll get together again. And now you, Japan, you're in the hot box, or you, the US. Last year was the US's turn, right? The US had to have the strong currency so the euro could be super weak, because Europe was on the verge of collapse. Yeah. Remember all the dire things about in Europe? European stocks have crushed it because they were able to devalue and sell a bunch of stuff, machine tools and cars, that they wouldn't have otherwise been able to sell because China was closed.
Yusko emphasizes that ultimately everything comes down to liquidity. He notes that the US money supply growth went negative for the first time in almost 100 years, which leads to economic activity by 16 months. Because of that, he predicts a downturn with moderate inflation and attributes this to the financing of the Japanese carry trade center. Yusko explains how Japan's zero interest rates allowed for borrowing and buying of other assets, facilitated by the Bank of Japan as the buyer of last resort for bonds. He notes that China flooded the world with money, which found its way into the real estate market in the United States. Yusko also explains that global liquidity is expanding due to a coordinated effort among central bankers to devalue their currencies and promote exports. This collaboration allows countries to take turns in having a strong currency while others devalue theirs. However, he warns that this process is net inflation generative, and it ultimately leads to the channeling of wealth to the top of the pyramid and impoverishing the masses. What do you think about Mark Yusko's latest market update for 2023? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.